Got quite a story today, digging into some sources about a really surprising event in the financial world.
That was pretty dramatic.
Over just 48 hours recently, the crypto market saw this incredibly violent sell-off. We're talking $18 billion wiped out.
18 billion in leveraged long positions gone, just like that.
Yeah, Bitcoin, Ethereum, everything took a massive hit.
And the trigger wasn't the usual suspect, was it? Not a hack, not some regulatory FUD.
No, exactly. It came straight out of geopolitics. That's the fascinating part.
It really is. Watching a political chat about, tariffs on actual stuff, physical goods,
Right.
instantly cause panic selling in digital assets. It's quite something.
That's the puzzle we really need to piece together today. The spark was former President Trump floating this idea, a potential 100% tariff on basically all Chinese imports.
That's the one. Just the idea, the proposal itself about this massive tax on goods, clothes, electronics, parts, stirred up so much macroeconomic uncertainty, it just unleashed this synchronized panic.
Forcing $18 billion in sell orders in crypto derivatives.
Exactly. If you ever needed proof that global finance is all tangled up together, well, this is a pretty stark example, isn't it?
Okay, let's definitely unpack this. Our mission for this deep dive. Connect those dots. How does a political promise about trade taxes cascade into a crypto market meltdown? We want to give you that shortcut to understanding this new reality.
Sounds good. So first, we should probably lay out just how extreme this 100% tariff idea is and why the traditional markets took it so seriously, almost like an existential threat.
Okay.
Then second, we'll dive into what happened immediately after, really focus on the mechanics of that $18 billion liquidation cascade. How did that actually work?
Right, the dominoes falling.
Exactly. And then finally, zoom out a bit, look at the bigger picture. What does all this volatility actually tell us about where crypto fits in the global financial system today? Its evolving role.
All right, let's start with that shockwave, the potential 100% tariff. Now, most people know a tariff is a tax on imports, but 100%, what makes that number just so extreme?
Well, it's the sheer scale, really. A 100% tariff, it means pretty much every single physical product the U.S. brings in from China. Its price effectively doubles instantly.
Doubles, wow. So we're talking servers, iPhones, laptops.
Yeah, all the high-tech stuff.
Yeah.
But also everyday things, furniture, clothes, car parts, industrial components, you name it.
That's a huge immediate cost hike. It's not just tech companies feeling that. It's almost every part of the economy that uses global supply chains.
Precisely. I mean, the intended goal might be, bringing manufacturing back home, reshoring.
Sure.
But the immediate guaranteed effect, massive cost push inflation. Yeah. And it's not a small bump. It would act like this huge continuous supply chain shock hitting the entire U.S. economy at once. You'd see growth likely choke while prices shoot up.
Okay, and this is where market psychology kicks in, right? Markets usually react to probabilities, not just hypotheticals. Why did big investors treat this idea, which, let's be clear, depends on an election, like a real threat they needed to react to now?
That's a really key question. Markets are constantly pricing in political risk, especially around elections. When a major candidate, a presumptive nominee, makes something like this a core part of their platform, investors have to assign a real probability to it happening. It's not zero anymore. And the sources we looked at show that big financial players, the algorithmic funds, they immediately started baking this tail risk into their models.
Tail risk meaning low probability, high impact.
Exactly. If the chance of a 100% tariff goes up, even slightly, then the perceived chance of a global trade war, really bad inflation, and the central bank having to hike rates in response.
Yeah.
That all jumps up dramatically, too.
So it wasn't the tariff itself causing the panic yet. It was the uncertainty it created, the sheer unpredictability.
Absolutely. Uncertainty is like kryptonite for financial markets. It's the #1 enemy. When you suddenly can't forecast basic things like inflation or interest rates 12 months out, the gut reaction for anyone managing large pools of capital is just de-risk, sell the volatile stuff, move to cash, get to the sidelines until things become clear.
Okay, I get why that hits stocks, bonds, commodities. But Bitcoin, isn't it sometimes pitched as, a hedge against exactly this kind of chaos? Fiat problems, inflation, shouldn't uncertainty drive people towards it? Why did it get dumped like a risky tech stock?
That's a really sharp point. And it cuts right to how this asset class has been changing. You're right. Some people, especially maybe retail investors, still see it that way, a long-term hedge. But the big players, the institutional whales who are actually moving the needle during this $18 billion event, they saw it very differently. For their portfolio models, Crypto is high beta risk.
Yeah.
Pure and simple.
High beta meaning it moves more dramatically than the overall market.
Exactly. So when that macro fear hit trade wars, inflation, slowdown fears, the order came down, sell high beta. And in that bucket, you find volatile tech stocks, emerging market assets, and yes, crypto. It wasn't an ideological move about Bitcoin's future. It was cold, hard portfolio management.
Got it. So the powder keg was set. Potential trade war, inflation fears, global slowdown, all from this one policy proposal. Okay, now let's watch how that fire spread specifically into the crypto space.
Right. So the jump from that macro fear to the crypto chaos happened pretty fast, in a few steps. As the uncertainty spiked, you saw the traditional markets flicker first. The S&P 500 dipped.
Okay, expected.
And maybe even more telling, the Chinese yuan weakened quite a bit.
Yeah.
That's often a big signal of global anxiety, especially around trade.
And that's the cue for the crypto market now that it's more, well, institutionalized.
Yeah.
With the ETFs and all that.
Precisely. The Bitcoin ETFs were the game changer, the bridge. Before, getting big money into crypto involved some friction operational hurdles. Now, it's basically just another line item on a fund manager screen. So when their complex risk models flashed, red, extreme macro uncertainty, detected the instruction was simple: sell high beta assets. And crypto, being inherently volatile,
Got swept up in that wave.
it got swept right up alongside volatile commodities, other risk-on assets, just part of a global selling program.
But that $18 billion figure, that's specifically about derivatives liquidations, isn't it? This is where crypto's own internal mechanics, specifically leverage, poured gasoline on the fire.
Yeah.
Can you break down liquidation for us? What is it and who's making these highly leveraged bets?
Okay, yeah. Think of liquidation as the exchange's safety net, basically.
Yeah.
It's automatic. Lots of people in crypto, from sophisticated trading desks down to very aggressive retail traders using margin. They use leverage, they borrow money, maybe 5 times, 10 times, even more, against their initial capital to make a bigger bet. Often a long bet, meaning they expect the price to go up. But if the price goes down instead, even by a relatively small percentage, say 10% down on a 10x leveraged position, boom, you're wiped out. Your initial money, your collateral, isn't enough to cover the potential loss anymore.
So the exchange steps in.
The exchange automatically seizes and sells your collateral on the open market to cover the loan. It's a forced sell. You don't have a choice.
So it's not just people panic selling their Bitcoin. It's computers automatically forcing billions of dollars of sales onto the market, whether traders want it or not.
Exactly right. And that's what creates this incredibly dangerous cycle, the cascade effect. Step 1. The macro fear triggers that initial selling from institutions de-risking.
Right.
Step 2. That selling pushes prices down, hitting the liquidation points for all those highly leveraged long positions.
Okay.
Step 3. Exchanges execute those forced sales, dumping more crypto onto the market to cover the debts.
Which, step 4, pushes the price down even further.
Exactly. Further and faster, triggering the next wave of liquidation sitting just below that price level.
It feeds on itself. That's how I say modest 3% dip driven by macro news suddenly spirals into a double-digit crash in hours.
That's the self-fulfilling prophecy of forced selling. That $18 billion, that was the sound of a massive amount of borrowed risk suddenly, violently unwinding, all kicked off by a political comment about tariffs.
Wow, it's a really stark illustration of just how volatile that derivative side is.
It is, and it hammers home the big lesson here. When the really big money in traditional finance gets spooked by global events, by policy shifts, crypto isn't an escape pod anymore. It's just maybe the fastest, leakiest boat caught in the same global storm.
Okay, we've clearly established that connection, the intertwined nature. Now, let's zoom out again. You mentioned this event kind of confirms 2 things about crypto that seem almost contradictory. It's maturing, but it's also still incredibly volatile.
Yeah, that's the real tension, is it? It's like crypto is in this kind of volatile adolescence phase.
Yeah.
On one hand, the maturity. Look how directly and instantly this market reacted to a major global macroeconomic policy idea, just like the dollar or oil or the yen would react.
Right. That really confirms it's arrived as a serious multi-trillion-dollar asset class. It's not just some niche tech hobby anymore.
And actually, there's a positive sign of maturity in how the system handled the stress, right? The exchanges, the infrastructure. They processed $18 billion in forced liquidations in just 2 days without completely breaking down or halting trading.
That's a huge point, actually. It's a massive stress test. And the core infrastructure, technologically speaking, held up. That's a big positive for the market's structural robustness.
Okay, but then there's the flip side.
But yeah, then there's the other truth. the hypervolatility. While the stock market might dip, say, 2% on some big macro news, crypto plunged way more, largely because of that 2047 leverage machine we just talked about. You know, a 10% drop in a day might cause panic on Wall Street, but in crypto, it's almost seen as just a really sharp correction, amplified. That shows it's still in this highly leveraged kind of adolescent phase. Sentiment is fragile. So you've got the weight of institutional money adding legitimacy. But you also have the systemic risk from all that leverage, mainly in derivatives, providing this explosive potential for volatility. Sounds like maybe the worst of both worlds in some ways.
It can certainly feel like that sometimes.
Yeah.
But it seems to be the new normal, at least for now. And if we look ahead, projecting this forward, we absolutely have to expect this sensitivity to policy news, especially U.S. policy, to continue. Crypto has basically become another asset caught up in these big macroeconomic debates.
Like a macroeconomic football, as one source put it.
Exactly. Any big news on inflation, interest rates, or critically, like we just saw, geopolitical tensions, trade wars, it's going to send ripples through the crypto markets now.
That really changes the game for anyone involved in crypto, doesn't it? Just watching on-chain data like wallet activity or transaction volume, that's clearly not enough anymore.
Definitely not. The big takeaway for you listening to this is that your crypto playbook has to include serious macro analysis now. You need one eye firmly on the traditional financial world. The fundamental drivers for crypto prices aren't just about adoption curves or tech upgrades anymore. They now very clearly include global interest rates, inflation expectations, and, yes, political risk assessment around trade deals, foreign policies, the works.
You need to understand what the Fed's doing, how China might react, and how some giant hedge fund that holds both Bitcoin and, say, Apple stock is going to adjust its overall risk exposure based on that news.
Precisely. Diversification, understanding your real risk exposure, especially if using any leverage, it's all become absolutely critical. This whole episode is a painful lesson in what happens when you underestimate those links between Washington, Beijing, and your crypto balance. So just to quickly wrap up this deep dive, we started with a political proposal, that 100% tariff idea, that injected huge macroeconomic uncertainty, fears of inflation, trade wars.
Right, which triggered immediate de-risking across the board.
Exactly, a sell-off in anything considered risky. And that now definitely includes crypto for the big players.
And then crypto's own high-leverage structure took that initial dip
And amplified it massively into that $18 billion liquidation cascade through forced selling.
Yeah. The bottom line, the essential finding here, seems to be that the idea of crypto as some separate, isolated financial island, those days are just over.
Completely over. It's all deeply interconnected now. Global finance, policy, digital assets. It's one big system.
Absolutely.
Which brings us to a final thought, perhaps.
Since we've seen how tied volatility is now to policy announcements outside crypto, we just saw a trade war proposal cause an $18 billion cascade. Makes you wonder, doesn't it?
Wonder what?
Well, what happens when the next big shock isn't about trade policy, but about monetary policy on a global scale? We focus a lot on the U.S. Federal Reserve, naturally.
Sure.
But what kind of cascade could be triggered by the next major, maybe unexpected interest rate move from another huge central bank, say the Bank of Japan or the European Central Bank? If a sudden shift in global rates sends billions flying across asset classes in minutes.
How much more will the leveraged crypto market amplify that shockwave?
Exactly. Something to definitely keep in mind as you navigate this increasingly complex financial world.
It really pays to look beyond just the crypto charts and maintain that wider global perspective now more than ever.
Couldn't agree more.